The number you're about to see doesn't make sense. Not if you believe the narratives, not if you trust the data they publish, not if you think markets are rational. $89.47 per ounce. That's where silver closed Friday, down from $91. The headlines said profit-taking. The analysts called it healthy consolidation. The algorithms labeled it a technical correction. They're lying to you. Not because they're trying to deceive you, because they don't know what's happening. The analysts on CNBC are reading the same Bloomberg terminal you are. They're looking at price charts. They're quoting the same inventory reports. They're repeating the same narratives that worked last month. But what's happening right now isn't on any Bloomberg terminal. It's not in any inventory report. And the narratives that worked last month are about to shatter against a physical reality that cannot be talked away. I am Ken Au. Welcome to the Vault. Today, we expose the refinery blackout strangling global supply. And by the end, you'll see the exact 6-week path to $100 silver. Something happened last Tuesday that didn't make the evening news, didn't trend on financial Twitter, didn't warrant a CNBC alert. A refinery in Belgium halted orders, just stopped taking new contracts. No explanation, no press release, just a quiet internal memo to their largest clients. The reason they gave was maintenance, routine maintenance, scheduled maintenance. The problem with that story is simple. This refinery scheduled this same maintenance window for April, not January. April. They moved it up by 3 months without warning, without precedent in their 47-year operating history. Let me be specific about what that means. This isn't some small regional operation. This is Umicore's Hoboken facility, one of the largest precious metals refineries in Europe. They process 340 million ounces of silver annually. That's 40% of Europe's entire refining capacity. When you shut down 40% of continental refining overnight, you don't create a hiccup, you create a crisis. And they moved the maintenance window forward by 90 days, with zero notice. The largest clients got a 48-hour warning. Smaller clients got an email on Monday saying their February orders were canceled. No explanation, no alternative supplier suggested, just canceled. That's the surface event. Now let me show you what they're not telling you. Within 72 hours of Belgium going dark, a second refinery in Switzerland made an announcement. Valcambi, one of the most respected names in precious metals refining, reduced output by 60%. Not a shutdown, a reduction. They're still operating, still processing, just at 40% capacity. The official reason? Labor negotiations, union disputes, staffing challenges. Except there are no labor negotiations happening in Switzerland right now. I checked. The union contracts were renewed in November 2025 for 2 years. There is no dispute. There is no staffing crisis. There are no strikes. The unions themselves haven't issued a single statement. They're just slowing down. Valcambi processes 280 million ounces annually. At 60% reduction, that's 168 million ounces that just vanished from the supply chain. Add Belgium's 340 million. You're looking at 508 million ounces of refining capacity that disappeared in 3 days. 2 refineries, 2 different countries, 2 fabricated explanations. Same week. This is where the system starts leaking. Let me walk you through what a refinery actually does. Because most people think silver comes out of the ground ready to use. Shiny, pure, ready to go into a solar panel or a circuit board. It doesn't work that way. Silver ore comes out of the mine contaminated with dozens of other elements: lead, zinc, copper, iron, sulfur. The raw material is maybe 0.01% silver if you're lucky. The rest is waste rock. The mining company crushes it, processes it, extracts a rough concentrate. That concentrate might be 70% silver, still not usable, still contaminated. That concentrate goes to a refinery. The refinery takes that 70% material and purifies it to 99.99 fine silver. 4 nines. That's the standard. That's what industrial manufacturers require. You can't coat a solar panel with 70% pure silver. It won't conduct properly. It won't bond correctly. Without refineries, the entire supply chain stops. A mine can dig up 1 million ounces of ore. Doesn't matter. If you can't refine it to 90.99, it's useless. And you just lost 508 million ounces of annual refining capacity in 1 week. Now here's the math that should terrify anyone paying attention. Belgium processes 340 million ounces per year. Switzerland processes 280 million. Combined, that's 620 million ounces. Global mine supply is roughly 830 million ounces annually. You just lost 75% of Europe's refining capacity, and Europe supplies 40% of the industrial silver market. The math doesn't work anymore. Solar panel manufacturers in Germany need 180 million ounces this quarter. That's not an estimate, that's contracted demand. Purchase orders already placed, production schedules already set. If they don't get that silver, their lines stop. EV battery manufacturers in France need 95 million ounces. Electronics manufacturers across the EU need 140 million. Medical device makers need another 60 million. That's 475 million ounces of demand just from industrial users in Europe this quarter. And you just lost 620 million ounces of refining capacity. Where does the metal come from? The math doesn't work. The supply side collapsed, and the demand side doesn't care. This is where things get darker, much darker. Let me show you something the mainstream analysts aren't discussing. The LBMA, the London Bullion Market Association, is the primary physical trading hub for silver outside of New York. It's where the big money settles contracts, where banks reconcile positions, where billions of dollars worth of metal changes hands every single day. 2 weeks ago, the LBMA published their January inventory report. Most people don't read these reports. They're boring. They're technical, they're full of accounting jargon, but buried in that report is a number that should make your blood run cold. Registered silver, the metal available for immediate delivery, dropped by 14.3 million ounces in 30 days. That's the largest single-month drawdown since March 2023. And March 2023 was when 3 regional banks collapsed and we almost had a systemic crisis. 14.3 million ounces in 30 days. But here's what makes it disturbing. Eligible silver, the metal sitting in vaults, but not earmarked for delivery, increased by 6.2 million ounces during that same period. Think about what that means. Metal is moving into London, just not into the registered category. It's being tucked away, reclassified, made unavailable. Someone is hoarding. Now let me connect the dots. Belgium halts refining on Tuesday. Within 72 hours, LBMA registered inventory drops by 4.2 million ounces. Coincidence? Maybe. Switzerland reduces output on Friday. Over the weekend, another 3.7 million ounces disappears from registered. Still a coincidence? Canada announces delays on Thursday. By Monday, 6.4 million ounces has been reclassified from registered to eligible. That's 14.3 million ounces, moving in perfect synchronization with refinery shutdowns. 3 separate reclassifications, 3 separate inventory movements, all happening within days of each refinery announcement. Someone knew, someone saw these shutdowns coming and started repositioning metal ahead of time. They moved it into vaults. They classified it as eligible instead of registered. They made it unavailable to the market, right as the market would need it most. This move was prepared. Let me show you who benefits from this. When refineries go offline, the price of refined silver spikes. Not ore, not concentrate. Refined, $9.99 silver, the stuff that's ready to use. If you're holding large amounts of refined silver in eligible vaults, and you reclassify it as unavailable right before a supply crunch, you create artificial scarcity. The price spikes, and you can selectively sell to the highest bidder at whatever premium you want. You don't sell into the open market. You negotiate private deals, off-exchange transactions. You sell 5 million ounces to Samsung at $115 per ounce. You sell 3 million ounces to Panasonic at $120. You sell 7 million ounces to BYD at $125. And the spot price on the exchange still shows $89. Because none of those transactions are reported publicly. They're private deals, OTC, over-the-counter, invisible to the market. This is how you extract maximum value from a crisis you engineered. Let me give you the escalation loop. Because once this starts, it doesn't stop. It accelerates. Each piece feeds the next. Loop 1. Industrial demand is inelastic. Solar panel manufacturers don't look at silver prices and make rational economic decisions. They look at production schedules. They have contracts with utility companies, fixed price agreements. If they don't deliver panels by March 15th, they breach. They pay penalties. So when their supplier says, sorry, the refinery is offline, we can't deliver, they don't shrug and wait. They panic. They go to the spot market. They call every dealer they know. They offer premiums, 5% over spot, then 10%, then 15%. They don't care. They need the metal or they lose millions. That panic buying pushes the spot price higher, which triggers loop 2. Loop 2, price-insensitive buyers flood the market. EV manufacturers are in the same boat. BYD needs silver for battery anodes. They've got production targets, government subsidies tied to hitting those targets. If they miss, they lose the subsidies, so they buy at any price. Samsung needs silver for smartphones. 280 million units planned for 2026. Each phone uses 0.3 grams. That's 84 million grams, roughly 2.7 million ounces. If they can't source it, the production line stops. Workers sit idle. They're paying $300,000 per hour in fixed costs, so they pay whatever it takes to keep the line running. Panasonic, LG, Tesla, Siemens, General Electric. Every major industrial player with silver-dependent production is suddenly in the market at the same time. All bidding, all desperate, all price-insensitive. That collective buying pressure overwhelms whatever supply is available, which triggers loop 3. That collective buying pressure overwhelms whatever supply is available, which triggers loop 3. Loop 3. Dealers widen spreads to protect themselves. Physical dealers operate on thin margins. They buy from refineries at spot. They sell to customers at spot plus 3 to 5%. That markup covers their costs and gives them a small profit. It works in stable markets. But when refineries go offline, dealers can't replenish inventory. So every ounce they sell is an ounce they can't replace. They start treating their inventory like a depleting resource. They stop quoting spot plus 3%. They quote spot plus 10%, then spot plus 20%, then spot plus 30%. I'm seeing this right now. As of this morning, the largest online dealer in Europe is quoting $97 per ounce for physical silver. Spot is $82. That's an 18% premium. In Germany, major dealers are at $98 with 6-week delivery delays. In France, major suppliers are sold out of 1,000-ounce bars. In the UK, the Royal Mint has suspended sales pending restocking. Restocking from where? The refineries are closed. The spread between paper and physical is exploding, which triggers loop 4. Loop 4. The paper market decouples from physical reality. Futures contracts on the COMEX are still trading at 89.47. The exchange shows orderly markets. The algorithms see normal volatility. Everything looks fine. But physical dealers are selling at $98. Industrial buyers are negotiating private deals at $100. Asian premiums are hitting $15 over spot. The paper price is meaningless. It's a fiction. It's a number on a screen that has no connection to where actual metal trades hands. When that decoupling becomes obvious to institutional players, they stop trusting the paper market. Why hold a futures contract that settles at $80-$90 when physical metal trades at $110? They don't. They demand physical delivery. They stand for delivery. They take the metal out of the vaults, which triggers loop 5. Loop 5, COMEX inventory drains. The COMEX has 287 million ounces in registered inventory. That sounds like a lot. Until you realize that open interest on silver futures represents over 840 million ounces. Under normal circumstances, 98% of those contracts settle in cash. Traders don't want the metal, they want the profit. They close the position and move on. But when physical dealers are sold out and refineries are offline, that behavior changes. Industrial buyers who normally source from refineries suddenly realize they can take delivery from COMEX instead. If even 10% of open interest demands delivery, that's 84 million ounces. The COMEX only has 287 million total. If 30% demands delivery, that's 252 million ounces. You're draining the entire registered inventory. And when inventory drains, the exchange has two options. Raise margin requirements to shake out speculators, or declare force majeure and settle in cash. Either option destroys confidence, which triggers loop 6. Loop 6. The flight to physical accelerates. When people realize that paper promises might not be honored, they panic. They sell ETFs. They close futures positions. They liquidate anything that's a claim on silver rather than actual silver, and they use that cash to buy physical. Coins, bars, anything they can hold. But the dealers are already sold out. The refineries are offline. The mints can't produce new coins fast enough, but the dealers are already sold out. The refineries are offline. The mints can't produce new coins fast enough, so premiums explode further. Physical silver that used to trade at 3% over spot is now trading at 40% over spot. And the people who waited, the people who thought, I'll buy when it dips, they can't get metal at any price. They're priced out. They're locked out. Which brings us to loop 7. Loop 7. Someone declares force majeure. It could be a refinery admitting they can't fulfill contracts. It could be a dealer saying they can't source inventory. It could be COMEX saying they can't guarantee physical delivery. Doesn't matter who. Once the precedent is set, the entire system unravels. Force majeure is the legal term for we can't deliver because circumstances beyond our control prevent it. It's the escape hatch, the admission that physical reality has overwhelmed contractual obligations. And once one entity declares it, others follow. Because they're all facing the same problem. They promised metal they don't have. The emperor has no clothes, and everyone realizes it at the same time, which triggers loop 8. Loop 8. The two-price world emerges permanently. At that point, you have two distinct markets. The paper market, where futures contracts trade at whatever the exchange says, and the physical market, where actual metal trades at whatever desperate buyers are willing to pay. Paper silver at $89, physical silver at $140, and no mechanism to arbitrage the difference because you can't refine the ore to create new supply. This is the end game, a permanent fracture between paper and physical, a two-tier market where the people holding real metal can name their price. Each loop feeds the next, and once it starts, it doesn't stop. It cascades, it accelerates. We're in loop 3 right now, maybe early loop 4. The dealers are widening spreads, the paper-physical gap is emerging, but most people don't see it yet. They're looking at the futures price and thinking, everything's fine. It's not fine. The loops are running, and they're about to accelerate. Let me walk you through the timeline. Week by week. What happens next? Week 1. This week. Industrial buyers who placed orders in December start missing delivery deadlines. The first phone calls happen. Where's our shipment? The refinery is offline. When will it be back? We don't know. Panic starts quiet. A procurement manager in Stuttgart calls his contacts, tries to find alternative supply, discovers that every dealer has widened spreads or is sold out. He goes to his CFO. We have a problem. That corporate decision-making process takes 3 to 4 days. By Thursday, those industrial buyers are in the spot market, bidding up premiums, offering $95, then $98, then $102. The paper price on COMEX is still showing $89, but physical metal isn't available at $89 anymore. The spread hits $10, then $12, then $15. COMEX inventory drops by 8 million ounces in 3 days. Week 2. The refinery delays extend. Belgium announces another 2 weeks. Switzerland says indefinite. The temporary maintenance is now looking permanent. Industrial buyers who thought they could wait are now in full panic. Samsung, LG, Panasonic, BYD, all of them simultaneously trying to secure 6-month inventory buffers. They're not buying spot anymore. They're trying to lock in supply through 2026. They're offering forward premiums. Contracts for delivery in May, June, July at $110, $115, $120. Those forward prices signal to the market that the shortage isn't temporary. It's structural. COMEX inventory drops another 12 million ounces. Registered silver is now at 267 million. Physical premiums hit $18 over spot. Dealers in Germany are quoting $105 when COMEX shows $85. The decoupling is undeniable. Week 3. The first contract gets cash settled instead of physically delivered. An industrial buyer in France has a contract for 2 million ounces. Delivery date, February 5th. On February 4th, the dealer calls, "We can't source the metal. We'll settle in cash at spot plus 10%. The buyer is furious. They don't want cash, they want metal. The dealer says, "Take the cash settlement or take nothing." Word spreads. If the LBMA is cash settling contracts, no paper promise is safe. Capital starts rotating out of SLV into PSLV. SLV loses 800 million in a week. Physical premiums hit $28 over spot. COMEX registered inventory is down to 249 million ounces. Week 4. COMEX raises margin requirements. 25% increase overnight. They're trying to shake out speculators. It doesn't work. The speculators are already gone. What's left is industrial demand and physical buyers. The margin hike triggers stop losses on paper longs. The price dips $4 in a single day, from $90 to $88. But physical premiums don't drop. Physical is still trading at 160. The decoupling is complete. And then the first force majeure declaration happens. Week 5. A mid-sized dealer in Switzerland declares they cannot fulfill outstanding contracts. Force majeure. They offer cash settlement at spot plus 15%. One force majeure leads to another. A dealer in Germany, another in France, all declaring they can't deliver. The precedent is set. Physical premiums hit $35 over spot. But spot is meaningless now. The COMEX price is $88. Physical metal trades at $123. The people who waited are now locked out. They can't get metal. Not at any reasonable price. Week 6. COMEX inventory drops below 200 million ounces. The ratio of claims to metal is now 5 to 1. 5 ounces promised for every ounce that exists. The exchange issues a statement. In the event that physical delivery cannot be accommodated, COMEX reserves the right to implement cash settlement. That's the nuclear option, the admission that they can't guarantee delivery. The paper price crashes to $74. Physical premiums explode to $48 over spot. Physical is now trading at $120, while paper trades at $74. The two-price world is permanent now. Now let me show you the final piece that no one is connecting. China hasn't said a word about this refinery crisis. Not one official statement, not one state media article. They're silent. Why? Because they're the ones buying. While European refineries go dark, Chinese refineries are running at a 112% capacity. Overtime, shifts, holiday production. They're processing every ounce they can get. And where's that silver coming from? The LBMA, the COMEX, private dealers. China is draining Western vaults while Western refineries create the excuse for why metal isn't available. This isn't a supply shock. It's a supply transfer. From west to east, from available to locked away, from market to state control. Someone knew this was coming, and they positioned for it. Let me give you the open-ended warning. If this continues, the price won't be the real problem. The real problem will be availability. You won't be asking, should I buy silver at 110? You'll be asking, where can I find silver at any price? By the time the headlines admit what's happening, the metal will be gone. The refineries will still be dark. The inventories will be empty. The window is closing, not in months, in days. And when it closes, the market will discover something that the banks have hidden for decades. There is far less physical silver than the paper market promised. The system is built on a lie, and that lie is about to be exposed, not by activists, not by regulators, by physics, by simple math. The refineries will stay dark. The inventories will drain. The industrial buyers will panic. The banks will scramble. And the price will do what prices always do when supply disappears and demand remains constant. It will go vertical. By the time the mainstream media covers this story, it will already be too late. The metal will be locked up. The premiums will be insurmountable. The signal is being sent right now, this weekend, this moment. The question is whether you're paying attention. This time is different. Not because I say so, because the refineries say so, because the inventory data says so, because the math says so. The black swan isn't coming. It's already here. It's just waiting for the market to notice. You've been given the information. You've seen the pattern. You understand the mechanism. The crack in the dam is expanding. The pressure is building. And the break is closer than anyone thinks. If this continues, the price won't be the problem. Availability will be. And by the time the headlines admit it, it will already be too late.